thanks for attending this call. On behalf of MT Global, I would like to welcome the management of Nippon Life Asset Management, and we thank you for giving us this opportunity. We have along with us Mr. Sandeep Sikka, who is ED and CEO, Mr. Pratik Jain, CFO, Mr. Saugata Chatterjee, Co-Chief Business Officer Distribution, Mr. Ashwin Duggal, Co-Chief Business Officer for Institutional, Mr. Paragya Saha, Chief Digital Officer, and Mr. Hiroshi Fujikake, who is nominee Nippon Life Insurance Director with us. Thank you very much, gentlemen, for giving us this opportunity. I will now hand it over to Mr. Sandeep Sikka, ED and CEO, for his opening comments. Over to you, sir.
Thanks a lot. Good evening and welcome to our Q4FY21 earnings conference call. We have with us Pratik Jain, Chief Financial Officer, Saugata Chatterjee, Chief Business Officer, Ashwin Duggal, Chief Business Officer, Arpan Saha, Chief Digital Officer, and Fujikake-san, nominee of Nippon Life Insurance from Japan. Overall, industry assets grew at a strong pace in financial year 21, driven by a rise in equity markets and increased retail participation. We expect industry to maintain the positive momentum in the next 3 to 5 years. Despite a challenging microenvironment, I am happy to state NAM India recorded its highest ever profit of rupees 6.8 billion in FY21. At Nippon India Mutual Fund, our priority is to be future ready and capture long-term opportunity. We continue to focus on 4 pillars to execute our profitable growth strategy with the investor first philosophy at its core. The focus areas include superior fund management, comprehensive product offerings, business de-risking through higher share of non-mutual fund segments, and robust digitech architecture that provides wide reach and best-in-class customer service. In FY21, we added over 9 lakh unique investors as compared to 20 lakh for the industry and increased our market share to 30%. SIP and STP folios rose by more than 1.1 million on a gross basis. Also, measures taken in the past quarters have had a very favorable impact on the short-term fund performance. We expect to raise the bar for ourselves in future. Today, Nippon India Mutual Fund offers the best industry suite of products in the passive category. We consolidated our portfolio through the launch of 8 NFOs in FY21, including 5 in Q4. With the passive assets gradually gaining prominence, Nippon India Mutual Fund is ready with its ecosystem in this segment and is far ahead of the industry in terms of investor base and mindshare. Post-consolidation in the last few years, we expect to grow our existing funds and expand into new categories of AIF and PMS. Along with the government mandates, we manage assets of rupees 1.3 trillion in non-mutual fund segments. The offshore business has assets of rupees 103 billion under assets under management and advisory. Leveraging Nippon Life's global network, we continue to ramp up our international presence. During this month, we signed a letter of intent for an exclusive strategic collaboration with Cathay, Taiwan's largest asset manager. We are the only asset management company to offer investment opportunities to Indian investors into Japan, Hong Kong, and Taiwan. We will continue to create such expressways and offer domestic and foreign investors more value-creative avenues to diversify risk and generate sustainable returns. A continuous and a consistent pursuit of digital-ready environment and robust infrastructure enabled Nippon India Mutual Fund to come out of COVID-19 crisis a stronger and tougher digital business entity. From being a digital leader in AMC space, Nippon India Mutual Fund is now moving towards being a digitech incubator. The goal is to drive class lending digital innovation to create competitive advantage and disrupt the investment space and with solutions that keep today's digital savvy millennium consumers at heart. Nippon India Mutual Fund's mature digital framework catering to various segments and business lines has not only helped to achieve robust and steady growth but also helped drive many new age industry first pioneering solutions for our investors and partners. Nippon India Mutual Fund has 3 proprietary applications and seamless integration with over 100 partners, including fintech players, traditional brokers who use our APIs for investor onboarding and transactions. With IBM being our strategic technology partner and tie-ups with other best-in-class service providers, we have a strong digital ecosystem in place. In FY21, we onboarded 350 institutional investors. We continue to have one of the largest retail AUMs in the country at rupees 643 billion. The contribution of retail AUM to total AUM is amongst the highest in the industry at 28% compared to 22% for the industry. We continue to be amongst the leaders in the beyond top 30 cities category. This category contributed an AUM of rupees 413 billion. 18% of the assets are sourced from these locations as against 16% for the industry. As on March 31st, 2021, 66% of our individual assets have a vintage of greater than 12 months. The annualized systematic transaction book is at rupees 79 billion. During Q4, new digital SIP registrations grew by 46%. In volatile markets, folios with low ticket size have demonstrated higher vintage and better stickiness. As it is abundantly clear from our 9 NFOs this year, including the largest digital NFO of Nippon India Multi-Asset Fund, online and digital assets have become a key source for investor acquisition and communication. Digital assets contribute to 53% of our total new purchase transactions. 1.8 million purchases were executed through the digital assets, an increase of 31%. In the ETF segment, we are one of the largest players with a market share of 13%. In this segment, Nippon India Mutual Fund manages assets of rupees 373 billion. Excluding EPFA allocations which go to 2 PSU-owned mutual funds, we would be the largest ETF player in the country. The Gold ETF is the largest fund in the category with in excess of 54 billion in assets. Nippon India's share in industry's ETF folio stands at 42%. In FY21, we added 1.4 million investors in this segment against 97,000 in the previous year. Nippon India ETFs has 72% share on of ETF volumes on the stock exchanges. Nippon India ETF's average daily volumes across key categories are by far the highest in the industry. In our AIF business, we manage Category 2 and Category 3 AIF across various asset classes. Nippon India Digital Innovation Fund has committed funds of USD 100 million and has initiated investment activities. As on March 21, Nippon India AIF has raised commitments in excess of rupees 37 billion across all funds. Nippon India Mutual Fund has a diversified, nimble distribution base. As on March 21, we have approximately 78,400 distributors and panel with us. The mutual fund distributors base rose to over 78,100. Also, we have ongoing tie-ups with over 20 prominent digital partners. Direct channel contributed to 54% of the MF AUM. Of the distributed assets, share of mutual fund distributors was 57%. 83% of the distributed assets are contributed by individual investors. Nippon India Mutual Fund, with a wide presence through approximately 290 locations across the country. We continue to review our existing branch operations and future expansion plans. Given the new normal, our marketing efforts are increasingly focused more on digital channels, which are more cost effective as against offline. Now on our financial performance. For the year ended March 31, 2021, profit after tax was rupees 6.8 billion, an increase of 64%. As on March 31, 2021, AUM was rupees 2,218 billion, an increase of 36% against March 20. Overall operating expenses decreased by 14% to rupees 5.4 billion. Consistent focus on cost optimization and rationalization over the last 2 years has resulted in reduction in cost across all segments. Operating expenses as a ratio of average assets under management reduced from 30 basis points in FY20 to 26 basis points in FY21. We continue to grow organically through our physical and online channels in active, passive and non-mutual fund segment. Additionally, we remain open to evaluate investments in our inorganic opportunities and strategic partnerships to enhance our capability across mutual funds, alternate segments and distribution. Due to non-availability of inorganic opportunities at the appropriate valuations, and which could not complement NAM's existing business model, no actual acquisition could be done during the last year. Also, the non-mutual fund segments saw slow growth, highlighting highlighted by slower economic growth and COVID. Given this situation, we will not push into expanding the available resources unless we see an opportunity to add profitability and complement our existing businesses, and ultimately it is in interest of the minority shareholders. Board proposed a final dividend of rupees 5 per share, including the interim dividend of 3 rupees. This is the highest ever dividend payout announced by the company. NAM India has initiated the process to become a signatory to PRI, world's largest voluntary corporate sustainability initiative, and adopt ESG processes across investment funds and the company as a whole. As a responsible asset manager, we will continue to enhance capabilities to carry out stewardship responsibilities and give voice to minority shareholders who participate in our mutual funds. At NAM India, investor centricity remains our key theme. We strive to deliver a complete product of suite customized to investor needs, superior fund performance, and efficient client services based on comprehensive digital ecosystem. We are confident to continue our trend of profitable growth in the coming quarters. Before concluding, I would like to also welcome our new board members, Mr. B. Shriram, who is a banking and financial services veteran, having a rich experience of 37 years, and Ideguchi-san, member of Board of Directors of Nippon Life Japan. We are sure with the induction of such esteemed individuals will strengthen our board, and we will continue to gain from the valuable guidance, specifically in the areas of finance, risk management, governance, and business growth. With these comments, we are happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj from Security Investment Managers. Please go ahead.
Hi, thanks for the opportunity. Just had a couple of questions. But just before that, I just had a humble suggestion. If we can keep a day's gap between the result release and, the Concall, I think that would be a little more helpful in terms of, going through the stuff and, making a more quality contribution. So just a humble suggestion. On the questions, just our first question is, if we look at our past in, say, last year, we clocked an average AUM around 2 lakh crore. And even after that, our overall operating profitability was around 160, 170 crores kind of a range. I'm talking about operating profit EBITDA. Now, if you look at this year, despite of, higher AUM, we still are in that range itself. So, if you look at the other expenses and everything, at what stage we see, gains from operating leverage kind of kicking in for us. And this quarter also we've seen some kind of spike in other expenses. So is there any one-off in this or anything, any color you can provide? So that is one. Second is, if you can just provide some color in terms of market share, both on absolute and incremental basis in T30 and B30 CDs for us. So, yeah, that is second.
So
I'll take the first one. See, in terms of the overall revenue from the operations, this year the average equity AUMs were lower, as you know, because last year we started with the lower base. And therefore, there was if you look at the overall equity average annual AUM, it was down by about 10 to 12%. And correspondingly, the revenue was accordingly down by about 8 to 10%. But if you see from an operating profit perspective, from an expenses, last year we were at 633 crore. This year it is 542 crores.
the few, in the last quarter, there has been marginal increase, but these are of one-off expenses. Otherwise, from a basis point, if you see, expenses used to be 30 basis point of our AUM. Today, it stands at 26 basis point. And in terms of the overall realization also, we are at about 52 basis point on the net operating revenue. So we are, in line with the industry.
Okay, just coming on the operating profit bar, the reason I'm asking is if I compare to, say, March quarter of last year, right, we did an overall equity and, so if I combine hybrid as well, somewhere around 67,000 crores kind of a AUM. This year we clocked, somewhere close to around 90,000 crores kind of AUM, equity and balance. Still, one would think that the operating profitability, would be somewhat higher than.
Then you have to just compare the quarter on quarter. So if you see quarter on quarter, then we are operating income wise, we are 152 crore versus 150 crore last year. See, when you will try to compare this AUM, quarterly average AUM with an annual results, probably it may not give you the right result. So, for the comparative quarters, we have a revenue of 280 crores versus 255 crores, and a profit of 152 crore versus 150 crore.
Okay, and the one-off expenses and other expenses, what are these for?
Yeah, so, as mentioned that, during this COVID times, what we've been doing is we've been investing into our digital and technology infrastructure. So, the marginal increases towards that one-off expenses. And also we have transitioned out from our earlier Reliance Capital environment, and we have created our own, data center as well as our own infrastructure. So there has been some cost associated with these two elements.
Okay, and on the market share, if we can talk about it.
Yeah, so, if you see, we have seen, we have actually arrested, that there was a corresponding decline which we have seen over the past 1.5, 2 years, predominantly started with the group-related issues. But I think, this decline has been broadly arrested. And also we have seen, in terms of our performance coming back sharply. I think, last quarter we were, broadly flat in terms of our market share. And I think we look forward to improve our performance from here onwards.
Okay. Second question is, if we want to better understand the construct of AUM growth in the domestic mutual fund business over the next 3 to 5 years, the growth would largely be, coming for us largely in terms of higher incremental share and flows than the industry, or is it largely from existing scheme size getting better? So, why I'm asking, I'm asking this question is we've already seen other large mutual funds, where there's a stagnancy in terms of growth, especially in major flagship schemes, and at the same time there's an underperformance as well. So when we say in a domestic mutual fund business, how are we looking to drive growth over 3 to 5 years?
No, so as I mentioned to you earlier, and also Sandeep in his initial comments mentioned that, this year, was a good year for us, that we added almost 9 lakh unique investors compared to 20 lakh in the industry, which means that exactly that 9 lakh is not part of the 20 lakh. What we are saying is that 9 lakh is unique to us, right? So these are new to us. So basically the one investor who have left us or new investors who have added, so which means we have added 9 lakh new investors. Now, which speaks that, look, we are getting investor coming back to us.
Okay.
I think
This
should be a mix of both.
if I look at last 6 to 7 months, the FII flows into markets in India has been very strong. But when we look at flows or book scale in our international business, it's been relatively lower. So just want to understand why is that. I mean, one of the feedbacks we just wanted to give is that some of the agility or aggression in terms of leveraging parent network or launching new products to tap flows seems to be slightly less. So, in last 1 year, we've seen several new products being launched in passive active space by other funds, which could have naturally come to us. So, what are we doing on that front? That's all. Thank you.
I'll take that one. See, again, coming to leveraging the parent, I think there are a lot of, for us, last 18 months after the name change, after the 18 months, 12 months have been in a lockdown COVID scenario. And I think the focus has been a lot more to regain and to reestablish ourselves. I think we clearly have been trying to leverage the parent on various things which could be not beyond beyond only the products and the AUM. Having said that, I think we have launched 2 real estate funds in Japan. We have the digital innovation fund that I talked about. Our recent tie-up with Cathay is also, I think, because of the parent. And I think you will see a lot more happening. The last 12 months across the globe, all asset managers and across all asset owners have been going through a different challenge. So the last 12 months should not be seen as a benchmark. I think there's a lot that is happening, and you'll continuously be updated on a lot of initiatives that we are driving in the international markets and leveraging the strength of our parent to get new things into India.
Okay, I'll come back in queue. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, request to please limit your questions to 2 per participant. If you have further questions, you may rejoin the queue. The next question is from the line of Amit Nanavati from Nomura. Please go ahead.
Yeah, hi. I just had a question on OPEX. If I look at operating expense for the full year and just try and knock off the one-offs that were sitting in the base or either with the new regulations kind of netting off in the revenue itself now, it seems like employee cost and other expenses are more or less flattish on a YOY basis. Basically, your employee cost is down, but largely we had a 50 crore of ESOP sitting in the base, and probably the outsourced expenses and the brokerage and incentives are now netting off in the revenue. Just adjusting for that, it looks more like a flattish OPEX. Is that a fair way to look at it?
Yeah, you're right, Amit.
Right. So all the adjustments that needed to be done, either because of the whole regulatory changes or because of whatever one-offs we had in the base, is largely behind, and what one should expect from here on is more a normalized trend in OPEX. That's the way to look at it, right?
Yeah, absolutely.
Okay. And second thing, I just wanted to check on the ETF front, right? So just wanted to understand broadly, we've been more active in terms of and much more focused in terms of building a large ETF product suite. Just want to understand what are the yield gaps between, say, a more liquid ETF versus an relatively illiquid ETF. The reason I'm asking is basically just wanted to understand if liquidity becomes a right to win in this product, and to that extent the profitability trends could be meaningfully different, while it may still be much more lower than the active funds, but the profitability versus, say, a liquid Nifty ETF for us versus an illiquid Nifty ETF for someone else may be very different.
I'll take that one, Amit. So, Amit, if you were to go to slide 22 of our presentation, I think that will tell you about the volumes and the liquidity. And for a minute, if we forget, the profitability, let's not see from our point of view, let's see from the investor's point of view. For the investor who's coming into ETF, if there is no liquidity, there's an impact cost which could be as high as 2 to 3% between the ask and a bid. And that defeats the objective of coming into ETF. So I will not say liquidity is the only thing that is required to win, but liquidity is a prerequisite. So if you were to look at the slide 22, you were to look at some of the ETFs by name which are there. If somebody was to invest even 1 crore rupees in some other ETF, the bid ask, the difference can go to 3 to 5%. So I think liquidity is a prerequisite for this, and this is one segment where I think the volumes will drive volumes. So today, if you have to buy 1 crore rupees of ETF and the total liquidity available is 5 lakh rupees, you can't do anything. So from our perspective, I think we are happy to share. If you look at the Nifty ETF, X of Nippon ETF, we are 41 times the industry. If you look at the banking ETF, we are X Nippon, we are 27 times the industry. Gold, we are 11 times the industry. And liquid ETF, we are 56 times the industry. So I think it's a very big advantage.
Yeah, but just wanted to understand if that can lead to any pricing differential, say, versus what a competitor with a low liquidity may be charging versus what you would be charging in a like-for-like product.
I think I have always believed, I think we have to see to win this game, I think you have to see the investor first. I think for us, I think whether the few basis point plus minus fee, will it make a difference? I think the ETF is ultimately going to be a volume game, and how do you build a volume is more important. So I've been rather than getting an advantage of 1 or 2 basis point in ETF, I mean you can charge more. I think the key is, can you multiply at 10x? I think that's the way we see it. And from our perspective today, at an ETF AUM of 37 crores and a blended yield of, I think, Pratik, it will be about 19 basis point.
Yeah, X of CPS, yes.
X ETF, 19 basis point. I mean, I think, if I was to link it with the earlier question, the first question that came, the blended yield. Today, if you were to look at it, this is a segment which adds about 50 crores to the profitability. If you see the blended yield, you might say that the realization has come down, but if you see isolation, this is a segment which is adding 50 crores to the profitability. If it was not there, the profit would not be there. So I think, and from our perspective, we have always maintained, we will be launching products not thinking what is good for the balance sheet. We will be launching what things are in the product categories which are good for the investors, and in due course of time, it becomes good for all the stakeholders, including the shareholders.
Understood. Last thing, just on the distribution mix, I see banca is coming off meaningfully, right, in the last 3-4 quarters. Any reason specifically why is that happening, 28-30% to now 22%?
So I'll take this one. So see, what is happening, Amit, is that, on one side, obviously from a bank perspective, there is not much left from their fee-based income, and therefore they are trying to push other product where their revenue realization is higher per product or per SKU. And on the other side, many of these investors have become smarter, and they are coming into the direct. So if you see, last year our average was about 15% of direct in the equity alone. Now that has gone up to about 17 to 18%. So what is happening? Many of these investors are now also coming direct, and also the advent of the investor advisors, RIAs. This will eat up going forward into the bank augmented assets.
Understood. That's it from my side. Thank you.
Thank you. The next question is from the line of Kashyap Zaveri, please, from MK Investment Managers. Please go ahead.
Hello.
Yeah, Kashyap.
Yeah. Good evening, and thank you very much for the opportunity. I have just one question on the market share, which was discussed earlier. If you look at even particularly this quarter, at AUM of roughly about 2286 odd billion, and versus the market or let's say industry AUM of about 32 odd trillion. I mean, still we lost about 5 basis points market share even in this quarter versus the previous one. And over last about couple of quarters, you have been highlighting that it would be plateauing out, and probably we would get back to getting some market share. In terms of quantitative number, if you could highlight as to what's the strategy in place in terms of probably distributor, RIAs or products which would help us do this. If you can give any quantifiable numbers on this, that would be really helpful. And that also continues on the equity side also, where now probably we would be less than about 7% market share now.
So from a quantitative perspective, it's very difficult to put across. But if you see the trend in the decline, that has plateaued. Because obviously, last 2 years, actually bowed by both, some bit of underperformance, from our side as well as the group related issues. We saw, especially on the debt side, we saw a lot of asset moving out of our, asset. But what you've seen is, in some of the categories, especially with respect to the ultra short term and short term category, we have started getting back the traction, and our market share has improved. While in the areas of liquid as well as some of our flagship equity schemes, I think this is slightly lower. But I think with the recent improvement in performance, we see that we'll see going forward, we'll see some improvement in our market share.
And am I audible?
Hello. Hello.
Please go ahead.
Yeah, and in terms of unique customers, you gave I think what you mentioned was the number was about 9 million unique customers. I think that's the number that you mentioned. That was over what period? Sorry, 9 lakh customers.
So this is in the last 1 year. In the last 1 year.
Okay.
In last 1 year, we added 9 lakh new unique customer.
Okay.
Versus overall industry added 20 lakh unique customers.
Okay. So that's the slide number 24, the differential. Sorry, I sort of missed that conversation. If the last sentence that you mentioned was...
What I'm saying is,
yep.
I have added 9 lakh new investors.
Okay.
As well as, industry added 20 lakh new investors. But, the unique customers for us and them could be different. So I'm not saying this is not exactly same. But what we are saying is that, look, if overall industry has added 20 lakhs, we alone have added 9 lakhs. So which means that investors are coming back to us.
Okay.
To your question of market share, I think it's always the retail execution is always more difficult, and I think almost 40% of the new incremental industry investors coming is a very positive sign. And I think clearly we expect, after the downfall which has been arrested in the last few quarters and retail coming back, I think we clearly see the growth trajectory will start soon.
And in terms of market share, if you were to split up between, let's say, Insti and retail, would the numbers be? I'm not saying the percentages, but the reduction which has plateaued out, in overall AUM as well as the, equity AUM, would it be the same behavior in both segments, Insti as well as retail, or one would have probably been better than the other?
Again, normally Insti is never in equity, too much in equity. But I think
I'm saying overall AUM.
Overall AUM point of view, normally the institutional investors are the first one to come. I think we have seen the fact that about 350 new institutional investors, some of the most marquee names in the country, come back. That has already happened. Number two, coming back to retail and HNI. I think we clearly see a segment which we had one of the lowest market share was HNI. I think we have seen a lot of that recovery started, and I think especially coming back to the passive products. And retail, we have already shared the numbers with you. So I think it's across the board. I think we are seeing green shoots. And I think the next 3 to 4 quarters, I think you will see, a lot of these things that are happening have a lag effect as far as the market share is concerned. And I think you will see a positive lag effect on the market share.
Sure. Thank you so much.
Thank you. The next question is from the line of Kunal Tanvi from Banyan Tree Advisors. Please go ahead.
Sure. Thank you so much, and congratulations on the good set of numbers. So I had 2 questions. One was, if you look at the market share, when we look at the, AUM data, it has, 2 components. One is your flow data and one is the stock. Stock, I understand, will of course be impacted by the market performance as well. So wanted to understand any color on, flows, how we have been, looking at it. The reason I ask this question is because when we look at the SIP number, right, vis-a-vis the industry for this quarter, we have ceded market share. We continue to cede market share there. So any color on, what's happening there on the flow side, both in terms of SIP and overall? And the second question is, slightly from a longer term, perspective. So if you look at, the bank-led AMCs, right, so they have been growing very rapidly. In fact, this year also we saw them doing exceptionally well. So how do we look at that, and what do we think is the counter strategy to arrest the lost opportunity because we are not affiliated to bank, the mutual fund business?
Let me take the second question first. I think not affiliated to the bank. I think we may not be sponsored by a bank, but we don't see that as any disadvantage. I think we take it. I think we have one of the most diversified distribution setup. And again, I think this is what I mentioned earlier when we were talking about ETF and products and other things. Ultimately, what is good is for the investor is going to be good for all the stakeholders. You cannot have a situation that you have one bank, a bank as a sponsor, and it can only push your products. Beyond the point, it has to be a customer-centric approach. So I think I don't see the advantage of being a bank can be there for perpetual, forever. I think we rather would like to have a more diversified distribution coverage. And from our perspective, while we are present in all the private sector banks, public sector banks, and foreign banks, but IFAs for us remain one of our strongest. And we believe, I think today, to have a diversified and de-risked distribution model is more important than having one primary distributor, whether it's your parent or anybody else, which can be good in short term, but from a long term point of view, we don't see any inherent advantage in that. Because very different. This business is very different from insurance. I think what you have to understand, a banker may have a very big advantage in insurance, but cannot have a long-term sustainable advantage as far as the mutual funds are concerned. Because you'll have to have an investor-centric approach, and no portfolio can be created by just one fund.
Sure, I understand that, and I appreciate it. And when we look at the bank-led AMC, right, it is not just about the distribution, right? It is also about the preconceived brand or the trust that new investors typically would have over a standalone AMC for that matter, right? Because that's how they enter the market. That is the target audience for us, right? So from that perspective, over a longer term, how does that impact? I understand that and that is a trend that is seen across the industry for a longer period of time. From the brand and perception perspective, how do we look at it?
So clearly, I think that advantage for the brand can be there for some time. But like I said, I think it's if it's a new startup AMC, the gap is too high. I think for established AMCs at a scale and size that we are, and the parentage of Nippon, I think we don't see as a very big differentiator. I will not be able to comment on behalf of the entire industry and for other asset managers. But I think for the scale, size, and the brand and the parentage that we have, we don't see that as anywhere a big differentiator, big positive for somebody else or a negative for us.
Sure. Thanks. My question on SIP and flows.
Thank you.
Hello.
No, I think on the SIPs, I think as far as SIPs are concerned, there have been over the last 2-3 months, there have been a little bit of data. How the data has been coming from AMFI, and earlier it used to be live SIPs, then it was the in cash SIPs and cash. Then there was also a period when I think we were last quarter. There were 2 holidays in the starting of the month. The data got a little changed, But I think from our point of view, I think we have remained consistent. We are roughly having about nearly a flow of 6.6, nearly about 8,000 crores per annum annualized SIPs, about 35 lakh SIPs we are having. I think again from our perspective, one of the biggest advantage that we have, our SIP size is lower than the size of the industry, which adds to the stickiness. And I think for us, because we remain very active in smaller cities and towns, the stickiness will play out, I think, especially even more during the volatile markets. And that's what we saw, especially during the last 2-3 years, even when there were one of the promoter group issues or during the volatility, the stickiness of our SIPs was very good.
Okay, sure. I'll get back in the queue. Thank you so much. All the best.
Thank you. The next question is from the line of Azog Cedric from VNK Securities. Please go ahead.
Thank you for the opportunity. Sir, my question is with respect to your ETF philosophy. Obviously, we are very clear on the direction. So from a customer perspective and distribution perspective. So my question is, let's say incremental one HNI is coming back to us, and it is putting in or thinking of putting in 100 rupees in. So do we see ourselves in a position where he'll place probably 50 rupees in our ETFs and place the other 50 in the competitor's active fund, given the fact that we are pushing ourselves to be very good in ETFs, and let's say a competitor is pushing himself to be very strong and active, do you of course, I understand the incremental benefit that's coming from ETFs, but the delta, is there any possibility of that scenario playing out, that let's say worst case scenario playing out?
So I think I'd like to just clarify. I think for us, it is not ETF versus active. I think the approach that we are taking is it's a customer-centric approach. Let the investor decide what he wants to do. For us, active funds remain our bread and butter, and we continue pushing. And even today, 90% of our revenue comes from active funds. I think the ETF is a part of being future ready. I think as investors' behavior can change. I think we take pride in the fact that we are one of the few asset management companies, or maybe the only one, which is in a state of readiness if the investors were to move towards ETF. So I think first I want to just try to address that it is not active versus ETF. Coming to number two, as far as ETFs are concerned, unlike active funds, where an investor normally likes to diversify between 4 to 5 funds, in ETF he does not do that. I mean, because the underline is the same. So if he's coming in an Nifty ETF, he's not going to be going to 4 ETFs and dividing it. He'll typically come to one, and that's exactly the reason the size and the volume. I think what I mentioned earlier on the slide 22, that tells you the story. So I think from our perspective, like I said, I think we are very clear that I think active remains our core, but we do not want to say we will only push active even if the investor wants ETF. So we let this choice to be made by the investor, and we want to be in a state of readiness. If he decides to wants to go to ETF, I think from our perspective, we are a supermarket and we'll be ready with that.
Just to add a jokes to what Sandeep said in terms of data, see, the developed market, has about 40% of the money in the ETFs, while in India it is 10%. So, one is that, the growth, what Sandeep is mentioning. The other important data one has to understand is that in India, of the 10%, 85% comes from the institutional investors. So the point in here is that, look, it is not, when one say that, look, not retail, every retail investor is gearing up for the ETF. The ETF growth has come from predominantly from the institutional side. So once that trend changes, which is the 40% in US, and, that is what we are saying is that we are future ready for that change to happen.
So, I mean, if you were to go to today's, I think yesterday's ET Wealth, in the large cap, 3 out of the top 5 are ETFs. So I think we let the investor choose. We are not here to push what we want, what we feel is good for us. I think it's the investor has to make that call.
Got it, sir. And sir, from a distributor's angle, let's say an IFA, again, same ETF philosophy. I mean, will he be threatened given the fact that, okay, now that a lot of new launches are happening, everything is happening on the ETF side or passive side, whereas again, a competitor is launching an active fund. Will a distributor, I mean, have you faced that kind of questions when you do multiple calls with AFAs?
I would like to phrase this, I think when you talk ETF strategy, I would like to phrase it as a passive strategy. I would not like to only restrict it to ETF. So I think there will be set of investors who like to come for ETFs. I think there are different set of advisors, distributors who will prefer ETF. And for our conventional distributors, we have launched passive funds. So technically speaking, the underlying could be an ETF, but actually it's a passive fund. So I think like I said, I think it is not A versus B or A or B. I think both will coexist. I mean, the way I think from our perspective, whether it's active and passive, both will coexist. I think we need to be present in both. Similarly, both online, offline, both will coexist. I think so. I think from our perspective, we are being where the investor is, or what investor wants.
Got it, sir. That's it from me, sir. Thank you. Thank you for your answers.
Thank you. Request to the participants, please submit your questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Prayesh Jain from Yes Securities. Please go ahead.
Yeah, good afternoon. Good evening, sir. Great set of numbers. Firstly, for clarification on the OPEX, when you say that we had exceptional items or one-off items in Q4, do we mean that the run rate of Q2 and Q3 should be the ideal number that we should look at, or from a sustainable trajectory point of view?
Yeah, Prayesh, so, see, on overall basis, we have, our OpEx is down by about 90 crores compared to the last year. So, we keep working on, improving our operating efficiencies. But, we don't look at, per se, quarter-on-quarter numbers, as much. For us, this was one of investment what we did in terms of our technology and digital ecosystem, to make it more robust given the current scenario. And hence, the numbers are slightly elevated, but broadly, we have seen further reduction in the normal, run rate expenses, and which will continue to do so.
Okay. And second question is slightly of a longer term nature. How do you see the market share trajectory in B30 and your share of assets in the B30? And what would be a strategy to grow that segment in the next 3 to 5 years?
So I think very difficult to put a number to it. I think from our perspective, I think one of the biggest strengths has been execution in smaller cities and towns. If you were to see over the last 15 years, that's what we've been doing. Last 2-3 years we had a slippage due to whatever reason, and the fact that I think today we talked about 9 lakh new investor folios coming to us. That tells you, I think, the retail, whether retail is in B30 or is in top 20, does not matter. I think it's the retail which is the most critical part, and we'll continue focusing. One thing remains that I think it is very easy to replicate institutional, it is very easy to replicate other strategies, but retail, it's not very easy. The entry barrier is too high. I think to go to the small cities and towns, IFAs, relationship, everything plays a very big role. So I think we are very confident. I think that retail, small cities and towns, and with the further digital ecosystem that we have built up, and also I think in our presentation we have also a lot of things that we keep doing with small IFAs, geotagging, different campaigns which are one of a different type. I think we are trying to support these distributors, advisors, smaller markets. We are trying to have a very interesting mix of physical presence, physical relationships, digital infrastructure. So I think I'm very confident. I think next 2-3 years you'll see us gaining market share there. These markets are all about execution. I think it is nothing about strategy, and I think execution will hold the key here.
Thank you so much.
Thank you. Does this answer your question, sir?
Yeah, it does. Thank you so much.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Dhruv Shah from Ambika FinCap. Please go ahead.
Yeah, hi. Good evening, team. I just have one question on your SIP flows. We have seen industry growing on quarter-on-quarter basis almost close to 9%, but we have been flat. We have reduced our market share in the SIPs, and we normally are very strong on retail side. So can you just elaborate on the same? Why have been SIPs flow on quarter-on-quarter basis flat?
That is, you want to take it?
Yeah, hi. So if you can, this is Saugata Chatterjee. Now, when it comes to SIPs, it's very directly correlated to the equity performance. And if one has observed in the last 4 quarters, our performance has started improving from Q3 onwards. The near-term performance of our schemes. And reason why the flows of SIPs have now started plateauing in the last 2 to 3 months, and which is the clear indication that henceforth, as the performance sustains, the new SIPs will come with higher longevity, higher stickiness, and the old SIPs will continue to remain with us for long periods of time. So it has a direct correlation to the performance. And now the other side, we are getting very deep into retailing with our B30 focus. That will also lead us to get in more and more incremental SIPs, coming into our forte. The third part is the digital piece. I think, we have really gone strong on digital acquisition as well as increasing the digital footprint. We are finding a very, very strong traction of equity investors coming through our digital assets. which will again add to the volumes as we go ahead. So it's a combination of 3-4 factors which will now lead us to start getting the SIP book retained as well as show a growth from here on.
Right, right. But okay, thank you so much.
Yeah.
Thank you. The next question is from the line of Krunal Shah from Enam Investment. Please go ahead.
Yeah, hi sir. Congratulations on the good set of numbers. I have two questions. The first is on the revenue. Is there any one-off in the revenue line item for Q4?
No, in revenue you cannot, because see, the way, we are structured is that, the majority of our fees come from mutual fund, and typically most of it is accrued on a daily basis. So, per se there is no, but what makes you think there is one-off?
So, the thought was regarding carry. So we had this sovereign fund mandate. So I thought if there was some carry over there, that revenue would reflect in the revenue. That carry would reflect in the revenue.
Oh, no. As of now, there is nothing. While we do have, but if it will ever come, we will make it an appropriate disclosure to that.
Sure, great. The second question is regarding ETFs. So I think Sandeep sir mentioned that 19 basis points kind of yield we do. Can you share the OPEX in terms of ETFs? How is it versus the company average, or broadly something?
No, so see there, frankly speaking, most of the expenses have to be borne by the scheme itself. That is the new SEBI regulation. So per se, besides the the team what we have and their related administrative expenses, there are no expenses. So what we are talking about, the net yield we get is in the range of about 11 to 12 basis points.
Okay, 11 to 12 basis points. Okay, great. Thank you so much. That's it from me.
Yeah.
Thank you. The next question will be from the line of Kashyap Zaveri from MK Investment Managers. Please go ahead.
Yeah, thank you for another opportunity. Just one question. In terms of your, so you mentioned about 9 lakh unique investors, being acquired versus about 2 million for the industry. If I look at on quarter basis, that implies about 7 lakh customers out of 1.3 million which the industry added. Anything unique that would have happened in this quarter, because that run rate is significantly higher than what we have seen in the past for us as well as industry?
This is not for the quarter. This is for the financial year, 9 lakh.
Yeah. I understand it's for financial year, but I mean you give that data on quarterly basis also, right? So I'm just reducing quarter 3 number of the total customers that we had, which is 6.2 million, and now we have about 6.9, and versus 21.5 for industry, it is about 22.8. This is versus quarter 3, which implies an addition of 7 lakh in the fourth quarter itself.
Again, I think from our perspective, the digital infrastructure that we're building up, things are falling in place. I mean, very difficult to attribute any one particular reason, but I think it's a mix of multiple things which are happening.
Okay. Sure. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, this was the last question for today. I would now like to hand the conference over to Mr. Vignesh Shial of MK Global for closing comments.
Yeah, thanks a lot once again to the entire management of NAM India, and also thank you very much all of you for participating in this call. Thanks once again, and have a nice day. Thank you.
Thank you so much.
Thank you everyone.
Thank you.